Hello, everybody. This is Brandon with Crypto Trades and Tech. Just wanted to had some time to put out an update video. It's been a while since we've done an update. The last update I did was right after the halving. Price has basically been completely sideways since my last video. And in that last video, if you'll recall, what we talked about was the fact that obviously we had some stronger than expected price appreciation because of the spot ETF. I was looking at a $46,000. What I was looking for was potentially priced to be at $46,000 by the halving. Obviously, we had taken out the prior all-time high, something unusual in this quote-unquote cycle. But what I said is any price above $46,000 is healthy and is gravy. We were only expecting $46,000 up to the halving, and then I was expecting 6 months of consolidation at or below $46,000 before price broke to the upside and we had the most significant part of the bull market. Well, where are we at now? Well, prices continue to consolidate below the $73,747 peak that we put in earlier this year. We had a pullback all the way down to $53,000, just under the 200-day moving average, well above the $46,000 target. So, all in all, this market cycle is extremely healthy, robust, very strong. ETF inflows continue. I'm sure you guys continue to see people post. The ETF inflows are continuing to come in. So we do have still an expectation of a couple of months. We're currently about 14 weeks after the halving, and typically price doesn't really get moving in, again, 2016, 2020 until 24 weeks, 6 months after. Now in 2012 halving, 2012 and 2013, price did respond a lot faster, but obviously Bitcoin was far less liquid then, and price more immediately reacted to incoming supply of 50 Bitcoin per block dropping to 25. That was a pretty big early change. Now, the mechanics of the halving continue to be extremely relevant because as the market cap grows, the reduction of the incoming supply being cut in half still has a pretty profound effect. So when the asset's about $1 trillion or plus over $1 trillion asset now, reducing the incoming supply does reduce the necessary fiat buying power that has to come in to buy up the incoming supply. So the halvings continue to be, and we looked at in 2020, 2021, I was one of the ones saying that maybe we're seeing the death of the 4-year cycle because 2020 and 2021 were much lower than the expected move based on prior cycles and the Wyckoff distribution patterns and several significant bearish factors that really cut that bull market lower than we were expecting, namely the China ban on mining, and then all of the derivatives leverage that had to be flushed out of the system. But ever since then, the 4-year cycle has continued to repeat. Very, very predictable, repeated pattern here that you see. So we'll continue to monitor that and watch that closely. The halving is still going to have a significant effect, like I said, but the spot ETFs do make this cycle maybe an outlier, and I continue to believe that we probably actually outperform last cycle because last cycle we had some headwinds. We were moving in, again, China ban, derivatives, and then the Fed went into a tightening cycle. So we had a liquidity boom from the pandemic, but that changed the entire tenor of the bull market. This time we have the ETFs that seem to have some political tailwinds. We're heading into a easing cycle. The debt situation is only getting more acute in the United States. So there's a really good chance that we actually have a larger performance in this bull market than the last bull market. Regardless, even if it's the same, it should still be some explosive price action. But the expectation still is probably a few more months of sideways consolidation before we make a significant breakout. And you see, obviously, in 2020, price did respond. It went sideways for about 10, 12 weeks, and then we had a breakout above this, what was the swing high. So when the price started to sell off in 2018, when it bounced up to the 200-day moving average and got rejected for the rest of the bull market, that's the level I've marked on here. That level, that's where we broke above, came back to test it, and then the bull market was off. Now, 2020, obviously the bull market started much stronger than most of us anticipated, even for 2020, and it reached a really the real peak of the bull market from sentiment, from hype, and from leverage was in the early 2021 period. So very short and lower price move than expected bull market. But we have some tailwinds here that could set this bull market up to be also unique in several ways. So looking at the live BLX chart, it just really reiterates, ever since 2012 even, we've had this same consistent repeating pattern. It's really pretty amazing that we continue to have this pattern. So hopefully this continues to give us some good insights forward looking. Now I want to go through just some standard charts here. Looking at the lower time frame, I'm just going to go to the daily chart here on Bitcoin. It's, again, we've become way too familiar with these Wyckoff patterns. I'll tell you, this sell off to 53,000 was trickier than normal because that spring was maybe just a bit more than expected. But nonetheless, you'll see I have a tweet here where when we touched that 200-day moving average, I basically said, this is the first touch of the 200-day moving average in many months, basically. It's not the end of the world. And sure enough, it ended up being a fantastic opportunity to accumulate below the 200-day moving average. Now, based on my trading rules, I don't take on leverage when we're below all the moving averages, but this is a great spot to add spot positions, of course. And now we're in leverage trading territory in my book. So we've gotten above the 200-day, I believe this is the 120 I have on here. Yep, we're back to the 120-day moving average and the 50-day. So these last two pullbacks were right to the 50-day moving average. And you'll see here I've got this key swing level that's kind of the midpoint, 64K roughly, if it looks a weekly level. That's the midpoint of the range, more or less, 64K. So at this point what we did is we had a typical Wyckoff accumulation, spring kind of move, and then a very abrupt move back to the upper half of the trading range. And we've really just been consolidating above the midpoint of this trading range is what I'm seeing here. What we're looking for is what I would like to see is the 200-day, the 50-day, the 100-day, and the 200-day to all kind of reconverge and finish that consolidation period in here. What that would do is basically completely reset and put us back into a state like this, where you see the 200-day, all these moving averages bunched up. This gives us the opportunity for price to really spring out of there, resets all those momentum indicators and oscillators. But a pullback here, I'm personally looking to add. I've got about a $64,000, somewhere in the 64 range. So right at the 120-day moving average is 64.5. But we got this all the way down to 64,000. So I will be adding. I have a small margin position I've been personally building. I'll add a little bit coming to this level, and we'll cut it loose if we lose this daily bearish swing low right here. I will remove it. So I'm looking to buy between 64,850 and 64,000, somewhere in there, and then we'll probably go ahead and cut that if it were to lose that 63,222 swing low. Now, this continues to be a fantastic indicator of what we can expect. You see open interest really, let me zoom in a little bit, started to significantly climb on this little move, this bounce off of the $53,000 level. And we've reached a pretty high level of open interest. So not too unexpected for it to flush some of that open interest out. Look at funding rates. You can see here, and if I zoom in a lot, it looks like funding rates are rising, and they are, which is not great for immediate bullish price action. But in the larger history, it's still pretty muted. It's gotten way more overdone than this recently. But still, some consolidation and some pullback is to be expected here to purge a lot of this open interest that was chasing price on that bounce. I'm sure everybody saw the news. The U.S. government transferred 30,000 roughly Bitcoin to another wallet address. I haven't seen exactly if this is exchange and if they're going to be selling this or not. The speculation, I believe, is that this was sent to an exchange, and it is going to be probably an OTC auction, which people will say, doesn't have a direct price on the order book, on the live market order books, and necessarily doesn't have a direct bearing on price. However, trying to find over-the-counter buyers for $2 billion worth of an asset is going to remove those buyers from placing orders into the live market order book. They're going to be able to fulfill their orders more directly here. So, for example, say an ETF were to buy a significant chunk of this. Well, instead of having to buy on the open market to meet the inflow needs, they're buying here. So it still has the same net effect. It's still going to remove buyers off of the order book in the live market, which is going to allow price to pull back further or not to continue to rise, whatever it is, right? This is still overall selling pressure in the market. So, assuming they are going to sell $2 billion worth of Bitcoin, would again lead credence to the idea that we're probably going to be consolidating for another 2 months or so. We just had Germany sell 50,000 Bitcoin. We have the Mt. Gox coins continuing to be returned, and then now we've got the U.S. government selling. But all in all, the fact that we're in the mid-60s, we're in this very, large consolidation range, but we're way above, again, that $46,000 price level that I was looking to consolidate at or below through this point in the halving. That to me is extremely bullish, that all that selling pressure, and then we had a little bit of miner capitulation too. So a lot of the smaller miners are having to sell coins that they've been saving to be able to continue to fund operations because they're not profitable mining with electricity prices where they are, Bitcoin prices where they are. Many of the big miners are still profitable, but a lot of the smaller ones that have less efficient operations are not. Just for example, Riot just bought a Block mining. So that's just that'll continue to happen. The big miners will be able to continue to also buy up these smaller miners. So speaking of Riot, it's pulling back here right into the 50-day moving average. We had this gap. I was kind of keeping an eye on this. I thought maybe this gap would fill, and sure enough, it looks like it very well might get a gap fill on Riot there. I had started to build additional positions on Riot myself, and I was looking at $16, $17 to exit. I did sell a little bit on this move, but really our price targets are up here. So all in all, I know this price action on the miners has been a bit of a drag for most people. It's my opinion that if you're really sweating these little moves down here like this, you're probably over positioned. If you have the vast majority of your Bitcoin trade in just spot Bitcoin, and these miners are just a small portion as a kicker, basically instead of buying altcoins, I've bought Riot and Mara. For me personally, the fact that they're kind of just fluctuating down here is somewhat irrelevant because, I built a smallest position compared to my Bitcoin position, expecting the miners to outperform at a specific point in the cycle. And when that is if you look at why did these big spikes happen on, say, I'm just looking at the Riot chart here, why did these big spikes happen in price in the past? Well, when Bitcoin breaks its prior all-time high and you get this hype cycle, the market until that hype cycle starts, the market in general is still very negative on Bitcoin. It's really the minority of the market that is really bullish on pro Bitcoin, even today, even with Larry Fink out there talking about it, even with Trump's presentation. The market in general is still probably, more people are probably not really interested in it. So when you look at the people who are looking to short the asset or get exposure to shorting the asset, they still do use these miners significantly. We just saw a big hedge fund come out and say that they were shorting Riot just a couple months ago. But what happens is, so that's because people who are not really sold on Bitcoin, they expect it to go to zero. They just continue to expect that it's just some meme asset that's just going to eventually fade off into obscurity. So they're more than willing to short and or not buy assets that are related to Bitcoin. Now, however, when the price breaks the prior all-time high, you get this hype cycle, this new influx of people looking at the asset. The market in general, the overall market, the forward price expectations for Bitcoin change dramatically. Instead of the market in general, at large, thinking that Bitcoin is just an asset that it was a bubble and it's fading back to zero, they look at it as, wow, this is really moving again, right? You get this hype cycle. So forward price expectations drastically go up. So right now, I bet most people, if you ask the average person on the street what the price of Bitcoin is, they would probably have no idea. They, you get answers all the way from a few $1,000s to, very few people would probably say it's $66,000. But as soon as we break that, maybe we get closer to $100,000. All of a sudden, everybody's going to know what the price of Bitcoin is, and everybody's going to start to talk. There's going to be a lot of talk, especially when Bitcoin hits, say, $100,000. You're going to have so many calls on all the big market channels and news channels saying that, bringing in people that saying that Bitcoin is going to $1 million. So when the forward expectation goes from Bitcoin just going to fade into obscurity and go back to zero basically and disappear, when the market changes and says, oh man, Bitcoin's over $100,000, it could go all the way to $1 million. Well, that forward pricing expectation changes the view of the miners significantly. And that happened obviously right here in 2017. It was pretty late in the cycle, but all of a sudden people started realizing that Bitcoin wasn't going to go away, and you had this flurry of activity, people forward pricing Bitcoin at much higher prices, which means now if you missed the opportunity to buy Bitcoin itself, what do you start looking for? You start looking for businesses that have exposure to it, or especially businesses that can producers of the asset, and that's where there's a flurry of buying coming into the asset. And this happened again with Riot in 2020 when Bitcoin had broken the prior all-time high and was surging. Then Riot significantly outperformed for a specific period of time early in that cycle up through, see here, February. So my expectation is just the same. I'm accumulating here just like as if it was, July, August, September of 2020. And at some point when Bitcoin breaks out, you're going to have this forward pricing expectation, and then the interest is going to again turn to producers. So, if Bitcoin's price is at $120,000, and people look around and they go, okay, this Riot or Mara or these large miners are able to produce Bitcoin at, say, $30,000 a coin, $40,000 a coin, whatever it is that their current production cost is. Well, that's a huge. They're producing this asset at far less than the real price, so it's a very attractive investment for a period of time. It appears to be, and you get this huge flurry of buying activity. Now, of course, I've got on here a potential, $123. In theory, if the peak of the fervor were early next year, you might get this, flurry of buying activity that pushes it all the way up there. That is not, this little yellow mark does not mean that I'm gonna wait and try to sell all my Riot at the very peak of this and try to get 100. I'm holding it all for $123. Does not mean that at all. I will sell some at 16, 17, 18. If we break that and pull back to it, I may rebuy some there. But by the time we're at $46 or so, I will probably be, significantly reduced position. If we were to make it to $79, I would be very, very light on this original position. And by the time we make it to $123, you can imagine I would only have a small fraction of what I had bought down here. However, say I still have 10% of the Riot I have now. If we were to legitimately get a 12x on that from, $8 to $10 when I was buying it to $123, that's a pretty significant trade even for that very small position. But in no way am I going to not take the opportunity to take profits as we move up here. Again, this is a kick for me. Riot, Mara, these trades are a kicker. That's just for a small position of portion of my position that, in theory, that small portion should at some specific point outperform Bitcoin. But it's just another way to get exposure in TradFi specifically. So that's what I'm looking at there on the miners. And of course, assets like MSTR is significantly ahead of Riot and Mara. Of course, that's because they have Bitcoin on their balance sheet, and they act. MicroStrategy specifically acts as a leveraged position, a Bitcoin leveraged position, basically. So I do have a little bit of MSTR and a couple of trading accounts, but it's also fairly insignificant to the amount of actual Bitcoin I hold in cold storage personally. But the idea here is, again, this gives me a TradFi, the ability to have some exposure in a TradFi account that's also has a little bit more upside than the base asset. But this is going to move, obviously, much more in line with the actual price of Bitcoin. So forward pricing expectations have a little bit to do with MSTR's price, but the vast majority of MSTR's price is what is the actual price of Bitcoin. Whereas Riot, the actual price of Bitcoin doesn't matter nearly as much as the market's perception of what price is going to be in the future. And that's the name of the game when it comes to these miners. So I'm continue to be of the conviction that this is a great potential trade for a percentage of your allocation toward Bitcoin or other assets. And this is basically, for me, this has replaced altcoin trading, right? So I've largely, mostly because I've gotten kicked off of many of the good exchanges, KuCoin, Binance, but also just because my interest in altcoins has waned significantly. The more I continue to monitor the space, the more I study the space, the more conviction I have that Bitcoin is, again, that apex asset that's really going to go after both the bond market and potentially real estate and demonetize those. And what does that mean to demonetize the bond market and the real estate market? Well, today, large institutions and sovereign nations, whenever they have excess capital, they'll park it in U.S. Treasuries and get a nominal yield. So they get, they park it in either Treasuries or 2, 5, 10-year bonds, and they'll get a 4 or 5% yield. But again, once the market understands the debt dynamic of the United States, it's going to become apparent that a 4 or 5% yield is not going to keep up with the money supply expansion. It hasn't been. Money supply expansion is between 6 and 7%, and it's actually accelerating now. So you really need 8 to 10% return on your fixed income assets, your bonds, treasuries, to keep up with true monetary expansion. So, of course, Bitcoin having a fixed supply is an asset unlike anything we've ever seen that is technically superior to parking your excess capital in bonds or T-bills. But then again, a lot of people around the world for real estate use real estate as an investment, right? So real estate, and it can be a good investment for sure. Rental properties, commercial real estate, those sorts of things are great. They can be great investments. But there are downsides with real estate. It takes maintenance. You have to pay taxes on it. There's a lot of downside with real estate, and real estate really is or should be a utility asset. It has a utility. Real estate, homes specifically, are for people to live in, and commercial real estate is a place for to conduct business. So, especially on the home front, on home sales and residential real estate specifically, there's a really good chance that Bitcoin will over time demonetize that, to where instead of having to basically save one of your biggest portions of your saving being your house or other properties that people might buy, it's a lot more efficient to just simply save in Bitcoin. And in theory, it should outperform most real estate, not all, over time. So those are just two examples of why the market cap for Bitcoin, in my opinion, the total addressable market is still much more significant to its current capital, its current market cap. When I look at the universe of altcoins, they're all competing, all of them, from Ethereum to Cardano to Solana to all the others. They're all competing for a slice that's a much lower total addressable market as really a tech entity, as a replacement for TradFi, as technology replacement for TradFi services. The biggest single use case, of course, for these is stablecoins. So that's not to say that Cardano, Ethereum, Solana don't have long-term value. They do. There's a lot of real utility that these assets have, but based on their current market cap, if you take all of the altcoins total market cap, have it here, total crypto market cap's about $2.3 trillion today, and you subtract that from Bitcoin's $1.3 trillion market cap, we get a total market cap in crypto. All the other assets combined are about $1 trillion. Now, I don't think that even in the most optimistic end state, as a stablecoin issuer and as DeFi services, that the entire market of that is worth much more than $1 trillion. So I think, another way of saying, I think that the altcoins in total are already completely capped out. And so at this point, what you're trying to do is you're trying to pick winners within that ecosystem. And, I think that's a really hard game to predict. And some of the big reasons I think it's really, really hard to predict, there's a lot of people who think Solana is, maybe the new winner. It's like the new Ethereum. It's now number 4 now. It's right behind Ethereum. And I'm strongly of the opinion, based on my understanding of the technology that Solana's technology stack that Solana uses, that it's significantly inferior to many of these others that are below it. And so I think the market will catch on to that over time. I think it's currently the darling of the market. And Ethereum, I think both Ethereum and Solana will probably significantly lose a lot of market cap over the next few years, on average. So through the course of a couple of bull markets and bear markets. Now, forward looking, I would expect Ethereum, Solana, Cardano, these others to do very, very well still when the hype cycle returns later this year, early next year. But I think this cycle, I continue to believe this cycle is going to be a very Bitcoin-centric cycle. We can go look at here's my Bitcoin dominance chart, and I continue to watch. So we had a low in 2018 of 35%. So Bitcoin made up 35% of the entire crypto, quote-unquote, market. Then it reached a peak of 73% or so. And then 2020, we had a Bitcoin dominance reach a peak of 74%. Means that 74% of the market cap of all crypto was just Bitcoin on that big price explosion in the bull market. Then it had a drawdown all the way down. 2022 reached 38% of the market, and now it's been slowly recovering. I continue to look for it to take out this 73%. What I believe is going to happen is that it will overtake this 73% dominance. Means that Bitcoin will be, once it takes this out and we reach, say, 77%, Bitcoin is going to be almost 80% of the crypto market, I believe, this cycle. And then then you'll have your alt season, and it'll sell off again to, say, the low 40s. But I believe that we're going to continue to see, most likely, higher highs and higher lows as Bitcoin dominance continues to march back up over time. And again, the reason I say that is all these things. I think the total addressable market for Bitcoin itself is so much larger as an asset class than the equivalent market cap for all the other altcoins that are really competing as technology plays. Again, not to say they don't have value, and it's not to say that some won't be great investments. That's to say that the obvious and simple investment, the simple win, as Warren Buffett would say, the fat pitch, is simply Bitcoin. And so my focus has turned to trading the Bitcoin cycles and these other assets like Riot, Mara, MSTR. I've pretty successfully traded them in and out for the past year. All these spikes I sold significantly and moved a lot of those profits over to buy more spot Bitcoin and then bought back in. And this is what I continue to do. So the Riot trade, when I exit my Riot positions, all through here, when I exit MSTR and Mara and these other positions, I will be saving that fiat that I acquired by selling that in my TradFi accounts. I'll be saving that, moving a portion of that off to crypto exchanges to buy Bitcoin in the bear market, in the coming bear market, say 2025, 2026, 2027, through there. I will use those trading profits to then try to buy back any potential bear market. That's not to say that we have to have a traditional bear market. We'll have to continue to monitor that moving forward, but that's the idea. And so that's where I've focused. So I continue to tell everybody that this cycle, all of these altcoins I've talked about for the prior cycles, I will be getting entirely out of all of these altcoins this cycle, including Cardano, which I like. I I say that, but I will inevitably keep a small allocation to some of these other ones I've held for a really, really long time. I've held a couple of ETH for extremely long time. Those might just stay on a wallet and forget about it. But the vast majority, stuff I have floating around in DEXs that I'm using for, liquidity farming, that stuff's going to be all dissolved at the top of this bull market. And we'll see what the future brings as far as that goes. One of the coins I talked about, I just noticed this chart. It's really, really bad. I talked about A0, and I had accumulated a position at about $1. So, obviously you look at this chart, I should probably give an update on A0. I haven't kept up with the development at all on it. I've been so focused on my Bitcoin specific trades and a bunch of other things I have going on that the reason I haven't even looked at this is I had purchased this on KuCoin, but U.S. users are kicked off KuCoin, and I don't have an exchange, a centralized exchange that I can even use to trade A0, and I don't know of any DEXs that A0 is currently on that are accessible to me either. So I'm basically, at this point, I'll be waiting for the bull market and a bounce wherever, if it bounces just back up into $1. If it does break out, I would imagine it'll probably break out and reach a couple dollars. But I'll be looking to exit this at any opportunity, but I really need to go hunt down. There's supposed to be a decentralized exchange launching on A0, and my thought process was I would just exchange A0 for another asset stable coin or something that might be available on that platform, and then transfer that out to a traditional whatever I can exchange it for that they can then transfer out to a traditional exchange. I'll look to do that. But this is at this point, as far as badly as this is sold off, apparently this is insiders, the VCs or whoever have been receiving their coins and just dumping them on the market. This is pretty standard. This is also why I'm kind of leaving the altcoin space in general. I've seen too much of this too many times. I've had some coins like VXV that I was excited about in the past that they've changed their focus. The founder of this coin has changed his focus from VXV, which was a really interesting AI coin at the time. They've changed their interest to another product called SBio. You'll see this over and over again where projects that were once really going. You look at my list. I'll go over here. Look at this list. You look at my list, my crypto list that I haven't updated for a while. I don't even know what this DeFi futures is called. It's funny. You'll see a bunch of dead coins in here. Like there's Waves is no longer on. Kraken, Binance took Monero off apparently. Ocean because of the merger, I guess. Ocean and OXS is Orchid, I believe. So I guess Orchid is now no longer on Gemini. But you just see this. There's just so much. There's so much death of projects out there. It just becomes less interesting over time to keep up with what's happening, especially when, again, I still believe that inside the altcoin market, you're going to have a few winners, a whole bunch of losers, and it's becoming more and more difficult over time to predict where the hype is going to go. And I simply personally refuse to even mess with any of the meme coins. I just don't care. That's probably where the trading is nowadays, is all the meme coins, which I've got a few down here, I guess. Doge to BTC is not doing well. So I just have zero interest in meme coins playing the hype. So anyway, that's where I'm at. Okay, we're at 34 minutes. Let's wrap this up in the next few minutes here. So you'll see, again, I said that, this dip to the 200-day moving average wasn't the end of the world. It ended up being a really good accumulation on that dip all the way down to 53,000 below the 200. Same thing is going to be true of this current little dip we have here back to the 50 and the 120. No, as long as it holds the midpoint of the range, it's very normal. I just saw Walker put this out a little bit ago. I thought this was interesting. This is just a macro. Just look at the macro situation. You look at M2 money supply growth. We had this huge spike because of COVID, but it's pulled back a little bit. But you look at the measured move from where the spike of the money supply expansion started to where it peaked out, the pullback is pretty insignificant, and M2 is already on the rise again. So that means broad money supply is on the rise again, and with that's a shockingly small pullback for such a big move. But we continue to rise. But you look at this, I thought this was interesting when you really consider this. Housing prices have kind of front run the M2 money supply for a while, and through the 90s, the 2000s, and then in 2008 we had a significant spike where housing prices did get well above the monetary base expansion, right? So M2 money supply expansion, housing prices did spike well above that, and then you got the pretty predictable correction in 2008 on housing prices. But ever since then, since they pulled back, what is this red line, median and average? Since they've pulled back, they've continued to keep pace with the money supply. But what's interesting is that you see here the median price. I thought it was interesting that the median price actually fell. This is not one-to-one, right? This is billions of dollars of M2 money supply to the median price and hundreds of thousands of dollars of the house. But the percentages should still be the same. This looks linear on both sides to me. So think of it in percentage terms. The percentage growth of M2 has outpaced housing prices since the 2008 crash. So M2 has, really rose significantly. Housing prices followed. Obviously, you see that the M2 money supply exploded and then housing prices exploded behind it. But what I find so interesting is that for the first time with that explosion of M2 money supply, your average home sales price fell below the percentage gain in percentage terms of the M2 money supply. So this kind of tells me, and I've said this, I thought that the housing, my expectation was the housing market would go sideways for a period of time and then break back to the upside. And so I kind of wonder if what we see is when M2 money supply starts to really rise here, if housing prices don't catch up and then pass. So I'm afraid for a lot of first-time home buyers out there that we may have another significant spike in housing prices coming here before too long as people figure out the debt situation. I mean, and the Fed, the reason this might happen, that housing prices might actually outpace M2 and probably will, is because the Fed is going to be forced to cut rates, because right now 5% interest rates are killing the Treasury with the debt spiral that they have going on more than it's hurting Main Street. So the average consumer doesn't seem to be struggling as much with 5% interest rates. Now, they are struggling more with the cost of groceries and things like that, but that has more to do with money supply expansion. And increasing interest rates, it actually makes the money supply situation worse because of the fiscal debt situation. But as far as interest rates go, I don't think 5% interest rates are really killing the market. 5 to 8%, interest rates that you're going to get on houses and cars and things like that, maybe up to 10%. And so dropping rates back down is necessary to help reduce the burden, the debt spiral on the government, but that's also going to re-accelerate large purchases, specifically houses, maybe cars, but houses specifically are, a 5% mortgage and a 2% mortgage. There's a pretty decent difference between, I guess mortgage rates really right now are like 7%. So if you start to cut rates and you can get mortgage rates back down to say 4 to 5%, the difference between 7% and 4% mortgage rate is pretty significant. So that could really significantly re-accelerate housing prices and slow down a small amount, not significantly, the fiscal spiral that's happening with the debt situation. So anyway, I thought this is interesting. But housing prices are like Bitcoin, are really just a great bellwether of the overall economy and monetary expansion. When you see housing prices go up, sometimes it's because you have a housing bubble like in 2008, but normally it's simply because it's tracking money supply expansion. And when housing prices are basically flat like they were from the late 80s into the 90s up to the early 2000s, it's because money supply expansion was a lot flatter all the way through the 80s and 90s. But as soon as money supply expansion started to ramp up, well, then housing prices respond to that as well. All right, everybody, we're right at 40 minutes. I'm going to cut it off here. Take care. See you next time.